a hedge fund chief who oversees $2 billion, explained why we have a 61% stock market crash over the next 18 to 24 months and shares the 3 types of companies he's currently revealing. Mark Yusko says that when the stock market crash comes, it won't happen overnight. It won't be fast. It won't happen overnight. Morgan Creek hedge fund manager told Business Insider in an interview on December 17th, it's a 2-year kind of relaxation. Still, the pain will be felt in the same way. Yusko said valuations are at record levels, stocks are in the midst of a bear market rally, and the S&P 500 will see 61% decline from current levels in the next 18 to 24 months. The main rationale for his dramatic claim comes down to the averages. He said that the valuation of the market has risen well above their fair value. It has been there for too long, and therefore is precisely due to a meaningful retracement. The table below took from advisor perspectives and showed the market's fair value average for about 150 years. The red line represents the trend of the average fair value price of the S&P 500, while the blue line reflects the S&P 500 price action. By definition, the blue line should spend time above the red line as well as below the red line. This is how the averages work, Yusko said. The blue line is above the red line for 19.5 of the last 20 years. But in 2009, we fell below fair value for a short time, he continued. Today, we have reached 154% of fair value, which means on reaching fair value, which will happen at some point, I don't know when, but it will. It's about 61% drop. The main culprits of this over-evaluation are of course mega-cap index-leading tech firms such as Amazon, Microsoft, Facebook, Apple, and Alphabet. Yusko compared the herd of investors here during the dot-com bubble with those at companies like Cisco and Intel, and said today's market leaders will eventually see downward price action as PE rates continue to rise. However, Yusko said that high valuations alone are not enough to cause a sale. He said that one of the potential triggers for the next year is that this year, with the increase of IPOs and SPACs, it continues without increased demand to match the pace of the stock supply increase. Among other potential catalysts, what he calls a high probability of disruption in the economic recovery process, further increases in COVID-19 cases and its corresponding lockdowns, and reduced share buybacks by firms point to their weak outlook. As for when such a dramatic setback could begin, Yusko said he expects to see the first turbulence at the end of Q1 and then towards the end of Q3 in September. We will probably have some rough times at the end of the first quarter, and then we will likely get a little more revitalized, and they realize that the economy is going into a rather bad recession and the recovery won't be that strong, they thought. I think next year could be a really tough year. However, Yusko said that while it is difficult to determine exactly when the 61% retracement will begin, he sees much of this happening in 2021. I would say most of this is in 2021, and the rest is in 2022, he said. I think it is a process of 18 to 24 months. How Yusko is prepared for collapse, and the 3 types of companies he's currently shortening. Because Yusko says there's a very low risk to reward ratio in the market, Yusko plans to have less exposure to stocks than he did for a long time, especially in the terms of a broader S&P 500 risk. However, it is not declining in the entire market. Yusko said he is proposing a diversified basket of cheaper assets, such as Bitcoin value stocks. Yusko also detailed the themes of his short positions. Although he refused to name certain companies, one theme is a group of vaccine companies. We think there is too much exaggeration about the vaccine. We think most vaccine companies will go bankrupt. We think it will be too much pain, he said. The way vaccines work is that someone wins and loses the rest. It's like there are no 17 measles vaccines. I think there are a lot of valuable companies in this industry. He also said it was a small company basket that he believed was fraudulent and similar to companies like Wirecard he shortened earlier this year. Wirecard was one of our great achievements this year, he said. Wirecard became one of the biggest companies in DAX, and then everybody bought it and dropped 99%. There may be some companies that are going through this in the United States. Finally, he said he had short positions at some traditional retail firms, which he said expect to be crushed by Amazon. He added that despite the unnecessary foundations, the number of these positions decreased this year due to the short congestion in November and December. One of our themes was what we call a traffic accident on Amazon, which is the death of traditional retail, said Yusko. We are currently in this strange environment with such large short periods in November and December. And therefore we are less exposed today than 3 months or 6 months ago. But traditional retail long-term will be challenged. Yusko added that although he wants to be really, he has not yet lacked any mega-cap technology company. He said he was planning to wait until he could move with higher precision. History as a guide. Yusko, the number of rising in the orbit of the market in 2021 is definitely lagging behind. Almost all the main players on Wall Street, including the largest investment banks, are seeing an upward path for the S&P 500 next year. But for those who suspect the 61% dropped he predicted in a financially harmonious environment, Yusko points to the deaths of previous sales. In 2000, everyone said Fed Greenspan would save the day, he said, but eventually the technology bubble burst and the market dropped 50% plus. It actually returned to a fair value. So the Fed didn't save the day. He continued, then in 2008, everyone said Bernanke is behind us, the Fed is behind us, and the global financial crisis occurred and the market fell 58% from peak to bottom. He added that the Federal Reserve's intervention to stimulate financial markets earlier this year was a temporary correction, and that the recovery corresponded only to a rise in a larger bear market that started in March. This time the market started to crack. It fell 38%, and the Fed went to the rescue, and everyone said, "Oh look, they saved us." Yes, in a way, I mean, there is no doubt that they stopped the initial landing, but bear markets can be really sneaky. It continued, going back from 1929 to 1932, and looking at the bear market, it took 3 years. The market dropped 48%, increased 48%, then dropped another 60% and fell 84%. And bear market rallies are very common now. It's slightly bigger than the average market rally, but not out of character. Most of the idea, comment, information, and criticism containing in these videos have been created by Daily News Report. Before making any important investment decision, use the information contained in these videos as a starting point for conducting your own research. If you make any investment or legal decision, it is advised to consult an expert before making this decision.